The stock market is currently closed, so we are looking at the final numbers from the most recent regular trading session on Friday, June 26, 2026 at 4 p.m. Eastern Time. Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, finished the day at exactly $0.3342 per share, marking a slight decline of 0.68% during regular hours. While a sub-dollar share price usually signals a company left for dead by institutional players, something entirely unexpected is happening beneath the surface of this microcap stock that has nothing to do with standard retail speculation. Pomerantz law firm and several other corporate watchdogs just launched formal investigations into the company on behalf of investors, right as the firm announced a massive legacy digitization partnership to preserve the digital identity and intellectual property of baseball legend Roberto Clemente. This creates a fascinating friction between massive corporate governance red flags and aggressive high-profile commercial expansion that most retail traders are completely missing while looking only at the pennies on the screen. When people look at an asset like this, the general expectation is simple. Retail traders surfing through various investing sites or scrolling their Robinhood stock trading feeds assume that a 33-cent stock is either a bankrupt shell or a lottery ticket positioned for a massive pump. They look at high-flying assets like Nvidia stock or Apple stock and assume that microcap technology plays follow the same predictable path of retail hype. The common ground among casual market participants is that Datavault AI is just another small software outfit trying to ride the coattails of larger data management firms. But the reality is far more complex, presenting a direct challenge to that superficial perspective. The company actually beat its first quarter earnings forecasts by posting a loss of 9 cents per share against the 14-cent loss Wall Street projected. Yet the stock immediately cratered nearly 15% after that announcement, dropping toward its current 52-week low of 25 cents. This stark disconnect forces us to analyze what institutional short sellers and law firms see that the average individual brokerage account holder overlooks. If you study the recent trading activity, the daily volume swings have been absolutely wild. Over 12 million shares changed hands in the final session of June, which is an aggressive amount of liquidity for a company with a market capitalization sitting right around $283 million. When you utilize tools like interactive brokers or look into deep data feeds on the Fidelity trading platform, you notice that this volume is not driven by long-term accumulation, but rather by intense institutional repositioning and massive short-side hedging. Over 35% of the outstanding shares are held by institutional investors, with major corporate blocks held by entities like Silex Holding Company and Viva Zor Inc. When large corporate insiders hold massive chunks of a sub-dollar company, the daily fluctuations become a battlefield between structured liquidations and desperate retail accumulation. This type of volatility is why many individuals seeking investment help tend to look toward automated systems like Schwab Intelligent Portfolios or a standard SoFi robo-advisor, rather than trying to time the wild intraday swings of an unstable microcap equity. The immediate pressure on the stock stems from a critical compliance and regulatory overhang. The ongoing investigations by multiple class action law firms are digging heavily into whether corporate executives misstated their financial strength or hidden capital constraints during their recent private placements. Datavault AI managed to maintain $250 million in liquidity, with $140 million in working capital, but they had to dilute shareholders heavily to secure those funds. For an investor utilizing self-investing models on a basic online investment account, this dilution acts as a heavy anchor on the share price. Every time the company attempts to rally, institutional blocks hit the offer side, capping the upside. Even as management pushes press releases about integrating their recent acquisitions of NYIAX and CyberCatch, the market remains heavily skeptical of their execution capabilities. Sector momentum in the broader small-cap tech space has been brutal, as high interest rates compress the valuations of companies that are not yet net income profitable. Comment below how many shares of Datavault AI you currently hold in your portfolio, or if you prefer to stick to safer assets. It is highly valuable to see how many of you are actually managing microcap positions across platforms like the Robinhood app or via active accounts on SoFi Invest. To fully understand why this price action is so detached from the retail narrative, we have to look closely at what Datavault AI actually does as a business enterprise. The company operates a proprietary technological infrastructure built around data valuation, structured data storage, and information asset exchange. Essentially, they try to take unstructured data sources, categorize them using automated algorithms, assign a financial value score to that data, and then allow corporations to buy, sell, or trade those data assets securely. Their business model relies heavily on corporate clients paying licensing fees for their core data management software and transactional cuts from their data exchange platforms. They have recently attempted to expand their market reach by pushing into tokenomics and asset tokenization, even securing a patent from the United States Patent and Trademark Office for data asset tokenization methods. They are attempting to position themselves as an infrastructure layer where companies can turn their private archives into structured, cash-producing digital property. However, looking back at their historical financial statements reveal a long track record of steep net losses that explain the market's deep-seated hesitation. In previous fiscal periods, such as late 2024 and throughout 2025, the company regularly posted negative profit margins exceeding 1,000%, with quarterly net losses routinely landing between $30 million and $50 million. Operating cash flow has historically been deeply negative, requiring continuous lifelines from financing activities, which means issuing more stock and diluting the people who buy in early. This creates a massive gap between the grand corporate vision of global data tokenization and the cold reality of a balance sheet that burns cash to stay alive. Investors utilizing premium investing sites or analyzing technical data on the Interactive Brokers platform can clearly see that without continuous infusions of outside capital, the underlying operational machine faces severe structural strain. Looking forward, the future outlook for Datavault AI is entirely binary, depending on two major catalysts that will either wipe out remaining shareholders or reward contrarian risk takers. The first is their heavy operational reliance on the pending Federal Clarity Act. Management has openly stated that their long-term data exchange network requires this specific legislative framework to pass so that corporate clients have clear guidelines for trading tokenized data assets. If Congress delays or kills the bill, Datavault AI loses its primary addressable corporate market overnight. The second catalyst is the execution of their ambitious 100-city infrastructure rollout, which includes deploying their system into major urban data centers. Managing an expansion of that scale requires flawless execution, a stark contrast to their history of integration struggles with past acquisitions. If their new digital identity programs fail to generate real cash flows within the next 2 quarters, institutional investors will likely force further restructurings. When we synthesize this entire landscape, the stark contrast between investor expectations and market reality becomes crystal clear. The expectation surrounding Datavault AI was that its earnings beat and high-profile intellectual property partnerships would trigger a rapid recovery toward its previous $4 highs. The reality, however, is a company trapped in a costly operational expansion, constrained by severe dilution and facing intense scrutiny from legal firms representing frustrated shareholders. For those engaging in online investing through individual brokerage accounts, whether you choose a hands-on approach via Fidelity Investments or a managed framework like an intelligent portfolio, this stock represents the ultimate high-risk laboratory. The technical indicators remain pinned in a strong sell zone, and the financial strength metrics show that while short-term liquidity is secure from recent funding rounds, profitability remains distant. It is a stark reminder that in the modern market, a promising technological concept can easily be crushed under the weight of structural dilution and intense regulatory uncertainty.